Howdy, folks. It's Donal Ward McCarthy here with 311 Realty Group. We're bringing you the fantastic Hugo Dos Reis, founding partner with Vine Group Mortgages here in Toronto, but of course they're across the country as well. So we're just going to today, we don't want to get too deep or too technical, but just kind of first of all touch on economy. Obviously, our interest rate rising right now. And the Fed's indicating that they might even do a 0.75 raise in June, which seems like a lot. So there's a lot of fear with our buyers and sellers, of course, in the market. And then, of course, we'll dig into the reality that Hugo sees with the big question we always get is variable versus fixed. So we're going to keep it fairly simple. We don't want to get too technical today. Because we just want to try and give you a good idea so that you can make up decisions moving forward. So yeah. Hugo, so what's going on? I mean, 0.5% increase last week with the Bank of Canada and the overnight lending rate.
Yeah, I mean, if you were to open up any news outlet or any newspaper right now, everything, we've been talking for the last 2 years about the real estate market, a bubble, all the crazy growth and the bidding wars. Now the conversation shifted to inflation and how high rates are going to get. That's like literally all that we see as headlines, and it's designed to make you want to click on it. And I think that sort of those headlines are creating a little bit of concern for a lot of people, because I probably get 3 to 4 calls every day, have been getting them for the last few weeks, about I need to lock in. I think I have I already had 2 calls this morning about I need to lock in. What's your rationale? Let's sort of understanding what's going on a little bit. And maybe I can add a little bit of color to how I see things, and understanding why it's happening and what the options are. Hopefully will help people make strategic and logical decisions versus immediately going into something that they may regret later. So, inflation is quite high. I was holding a headline yesterday saying that we're at 30+ year high for inflation in Canada. We've just broken the 6.7% range. Everything is expensive. I mean, I just finished a reno recently, and I can tell you that everything required, from the stone to the wood to whatever labor, very expensive. And I'm sure anyone who's out looking at their grocery bill or their gas bill sees how expensive things are. But I think we have to ask ourselves, why are things expensive? And there's a lot of reasons. One is the war, the conflict that we're seeing in Europe with Ukraine, with Russia. There's a spillover effect to that sort of a conflict where energy costs are very high. There's this risk premium in the market, meaning there's uncertainty around what this conflict will mean for the rest of the world and the already existing relationships with our trading partners. So that is going to add this elevated cost to what we do. There's also a big one for me, I think, is the supply chain disruptions we've seen. And I know this because anything that I've been trying to buy for the home that I moved into recently has been very difficult to get. So if you are trying to purchase anything, pretty much, I'll give you an example, piece of furniture. I needed a stove and a bunch of other appliances for the house. And it literally took us 6 months to get the actual appliances. And we didn't buy anything super exclusive or niche, just regular stuff. And it took us that long. And the reason there's a massive gap in getting goods and products into the country or manufacturers delivering is because they haven't been producing goods at the levels they were producing them before COVID. Because COVID sort of eliminated the need for all these things for a lot of people. People were home. They didn't need to buy goods and services, so they just stopped buying them. And manufacturers adapted. They brought down their capacity. They probably had a few people that had to be let go. And because of that, there was a huge slowdown in producing goods. Now that people are back in the market, they're back on the streets and traveling, and they're spending money on these goods, they're not able to get these goods in fast enough. And that, just like anything else, pushes up the cost of goods. So there's that theory on why inflation has gotten so expensive, right? So I think when you look at all those things, and not to mention how much money has been printed, literally like billions and trillions of dollars have been printed all around the world, making it very cheap, that generally is going to increase costs. So all those things have increased the cost of goods. Like, that's why things are expensive. So what I've been reading and what a lot of economists have shared is that, assuming all else being equal, and we don't have any new wars or any new, Godzilla, Omicron variant or whatever, right?
Yeah.
All else being equal, if we can get through the next, couple months or the rest of this year at slightly higher inflation, and they put measures in place to bring down that growth and bring down the inflation, which is why they're increasing rates. Ideally, by the end of next year, I read somewhere that we expect inflation to be closer to 5%. And ideally, by the end of next year, 2023, closer to that 2 to 3% range, which is what they call the neutral range, which is where the Bank of Canada likes to be.
Mhm.
If all of this were to happen, then rates, which are quite elevated today, should in theory also come down a little bit, because a lot of that increase in rates is as a result of trying to cool the economy
Of course,
and bring
yeah.
it down.
Yeah. I mean, we
So
need to do this rate and increase. So, I mean,
yeah.
I've heard as well too, like if we go to 5% even, that's not really going to rock our market.
Well, you probably know this better than I do, but like there's the supply and demand concept as well, where the supply of housing still doesn't meet the demand, and even with this increase in rates, I think it's almost like psychological. At least the amount of agents that I have across the country, the amount of mortgages that we see gives me a very good sample size of what's kind of going on. And we did see a little bit of a slowdown in our total amount of applications that right after the Bank of Canada announcement, but I think it was almost like psychological. People were just like, oh wow, rates went up 0.5%. And I think once it's sort of the dust settles, they're like, I'm okay, I can still do it. So I think we recently in the last week or so have seen more people coming back, getting applications in so that they can buy property. So I don't, like you said, I don't believe that this recent increase, and I don't believe a couple more increases are enough to scare people off, because there's way more people chasing few listings.
Exactly.
So that supply imbalance is going to create, in my opinion, ongoing demand for housing. And I don't think we're going to see anywhere near 20-30% increases, but I think we'll see slower, more reasonable growth in most of the markets in the country, at least the bigger markets.
I mean, we did see price decrease in the GTA from from February to March. There was a 3% decrease, but we're not expecting. At least I'm not expecting anything major to happen. And if they do raise very fast, and we get the first people who get shocked out of this market are the investors. They tend to be the first to get scared and put their rental properties on the market. Which,
depending on what side of the boat you're on, which is probably not the end of the world, because there's a lot of people who would like to get into the market that are end users. They're going to live there, and I think that we should be putting policies in place to help these people, especially right now. Obviously, as an investor myself as well, I still want to make sure that there's options to allow people to invest, but I think you have to reprice your model as an investor now. You have to assume rates are going to be a little higher. Qualifying is going to be a little more challenging. If it works for you, great. There's going to be a lot of those investors that are kind of outliers that wanted to get into the market because they saw someone flipping homes for a very generous profit, and they were getting into the market where they probably shouldn't have been. I think those are the ones that are probably affected. The serious investors probably are they're just repricing their model, trying to find specific opportunities that work for this new world that we're in. But I don't believe, with all the immigration numbers and the ongoing demand for housing and the shortage, we're talking in Ontario and the GTA, I think I read somewhere that Ontario is about 200,000 units per year short of the demand, especially with immigration now being increased. So I don't believe from a value perspective, we're going to see too much. And it was interesting because I saw an article that said real estate values will drop 20%. And I was like, well, on its own, that headline seems scary. But if you remember, well, they've pretty much gone up almost 20% in 1 year anyways. It's probably not a big deal if they drop.
You're back to 20. You're back to 20.
You're back to 17% adjusted in 1 year. Like, that's pretty impressive. Ask anybody in Alberta about that.
And of course, further to that, our GDP is almost back to what it was. The trend line for GDP pre-COVID, we're almost back there again. So supply, GDP, employment growth, population growth, yourself.
Unemployment's low. I mean, the fundamentals are strong. It's just the cost of goods has gone up because of all those things we talked about. So when clients ask me, should I go fixed or variable? At the end of the day, like, I don't have a crystal ball, and just like, like weather people, economists are wrong, can be wrong because they're making assumptions in like a silo based on data that we know today, but data changes. We didn't know we were going to have a war months ago, and that changes the dynamic and the option. So if you're asking me whether fixed or variable, I always say, well, historically variable has been a better option, but there's a lot of clients that generally can't sleep at night and that are very anxious. And I've spoken to a lot of those people, and I say to them, perhaps the best way to look at whether you should go from variable to fixed is let's stress test it. So let's take your rate and let's increase it by 2%. That seems to be the high end of the spectrum of what most economists are predicting rates can go to, at least from the Bank of Canada perspective. So if you pull up any economic forecast report from any of the big banks, this is all publicly available information, by the way, they're all predicting by 2023, 2024 rates will be about 1 to 2% higher. So if we assume that, and you can live with that payment, then just go variable. Stay on the roller coaster ride, But if you absolutely can't sleep at night, and this is going to have a massive impact on your cash flow, I think instead of a 5-year fixed, perhaps look at a 2 or 3 year fixed. It's shorter term. You'll probably pay a little bit more than you need to, but at least it gives you the peace of mind. And when the 2 or 3 year term is done, when I believe the market will reprice itself and will be in more of a neutral, stable environment, it'll then allow you to renegotiate at hopefully more competitive rates. But I mean, I think that we're going to see a little bit of pain. We're going to see a couple more rate increases this year. I think you have to accept that's going to happen and price it into your monthly payments and see how it affects you. And again, I've been telling clients, if you're going to go from variable to fixed right now, on average, you're going to pay 1.5 to 2% more. Like that's just the spread. It's a pretty large spread. We're seeing rates on the variable side, depending on the bank and the circumstances, in the mid 2% range or a little bit lower than that. But on the fixed side, on average, they're closer to 4% or higher. That's a pretty big difference. So the monthly payments immediately are higher. So I think there is real value still in going variable, especially for a lot of people, to be honest.
And as Benjamin Tal, like you say, there will be some shockers, I guess, coming out. What has Benjamin Tal said? We're going to see very, very fast increases right now just to get things under control.
I think that would be, typically when the Bank of Canada increases rates, they're increasing rates to obviously cool the economy, but that the impact of that increase isn't immediate. There's a bit of a lag between those increases going up and then impact to the general economy. So we probably won't see the full power of that increase for the next 2 or 3 months. And only when those 2 or 3 months have passed can we go back to the data and see if inflation has come down kind of to levels where we're at. And I think it's a tricky job to be working for the Bank of Canada or an economist to make those predictions, because if they increase rates too quickly and it's more than was needed to cool inflation, then you're basically putting us into a recession, which is another possibility as well. So it's a very difficult balancing act. So I think if another increase were to happen, I think they were saying sometime in June, potentially, like you said, 75 points. I think they're going to reassess the data by then, see if there was positive impact of that recent increase and see how much more they need to do. I think what will be interesting is the second half of this year. If we can't get inflation under control going into the second half of the year, then we may see more increases. And at that point, fixed rates start to look very attractive. But if we can get inflation under control, which I think is what the market has priced in by next year or so, I think there's some value in going variable, to be honest, still. But who knows? I mean, maybe we'll have another, variant or another world event that would just, change things up a little bit. So, but at the end of the day, it's got to be, I don't think we're going to see rates anywhere near the, the price points we saw in the early 90s or so, where they were 10, 15, 20%. I don't believe that.
Well, they'll be careful. They'll be careful not to do that again, because they learned from that experience, and it was a hard experience.
It was brutal. I mean, people reference that event a little too much, but I think the context of what's happening now is a little bit different than there. Obviously, very different circumstances than that period of time. So I mean, I think, look, at the end of the day, I think things will certainly get better. I mean, we're already not wearing masks as much as we need to, which is kind of positive. And I'm hoping that towards the second half of the year, we will see inflation come down, the supply chain get a little bit more streamlined, and you know, a little bit more of a balanced market, because it's been a little bit crazy to see real estate values aggressively go up so much. It's not sustainable, and I'm happy that, you know, there's a little bit more of back to reality here than any crazy crash or anything like that, which I don't believe would happen.
We do need a bit of that come back to the ground level.
Come back to the ground, exactly.
Just touch down at least your feet for a little while, and we are seeing that. You know yourself when you have to, either if you preemptively offer in a place that's set up for bidding wars and you just give that outlier price and you get it, or you wait till offer night. The environment in January and February was crazy. We saw 20 offers on listings. Then it was down to, which we always see, March, it had diluted by 100%. We're down to 10 offers. And of course, that was before all the rate, well, they were hinting at their rate increases and saying it's inevitable. Yeah. And now that that has occurred, and we did the 0.5 last week, the 50 basis point, we are definitely seeing some of the properties that are listed for auction style sales backfire. And they're then getting either price adjustments, or they're relisting with the more traditional style. Okay, here's what we want, bring an offer, we'll negotiate it out. Maybe we'll even get a condition in there. Those days are starting to come back a little bit.
Which is great, because you know how scary it is going into a market where you don't even know what the value is. You're like, you know, this could be $1 million, or it could be $1.5 million, and we have no precedent. This is just throw a number out there, and this you know, auction system, this blind system that we currently have, you know, I think it was scary, because we've had a couple of circumstances where clients bought last year in some of these markets just outside of the GTA, where you were able to get something in just under the $1 million price point, which previously, you know, we didn't need to go that high, and they are now seeing some of those markets having dropped $100,000-$200,000 from their 1 year timeline, and they're asking us for refinance, and we're saying the appraisal is lower than you bought it for. Like that's you know, that's scary. You know, they're gonna have to write it out now. But I think this is it's good to see that, you know, if I listed it for $1 million, it's going to be plus or minus $1 million within a reasonable range. I think that's nice. Question for you. You know, everything is different, obviously, so it's probably hard to answer this, but what sort of strategies are you using now on the sales side with clients? Are you looking more at trying to price it closer to what they needed? And
I mean, we're in that tough spot, and how I'm trying to differentiate whether we, you know, let's say, like you say, you put something on the market, it's either $1 million or 1.5, it depends on your strategy. But let's say there's a house that I feel is worth, let's say 1.3, let's say, but there's some stress or some locational stigma, and even through COVID, when we were selling duplexes and triplexes in places with tenants, I never ever adopted a list low, sell high strategy. Just doesn't work. It backfires. And so today, still rental properties, I'll adopt listed, let's say 1.3, and have offers come anytime. Or if the property is in a location that isn't the hottest, or there's just something wrong with the property that isn't going to give it that 10 out of 10 status, that people will still make a multiple offer situation viable. So we put a house on the market this week, and it is, you know, a really nice property in a great location, shows really well. We staged it, shows fantastically. That I felt comfortable still being able to adopt a list at 999, hope to sell it for whatever, you know, the $1 million plus, you know, 20, 30, 40%, whatever.
Got it.
And that could backfire. And I've set the expectation for my seller that if indeed that does occur with this shifting market, because 1 week to the next, the buyers can change their minds very quickly. And it's like you said at the start of the call, it's all psychology, just psychology.
Yeah, you're right. And I've you know, had the privilege of, you know, working with you on some of my personal stuff, and, you know, 1 week to the next, it's like quiet all of a sudden. So I think working with a realtor who really, really understands the market and can kind of quickly adapt to that is going to be massive. Because you know, I guess like in my industry, just like in yours, a lot of people have come into this industry thinking, I'm going to make a bunch of money because everyone's buying and selling. I'm going to be a broker, or I'm going to be a realtor. I kind of like to think that the actual quality agents and brokers in this market are now kind of popping up to the top, because now it's harder to get a mortgage, it's harder to sell and buy a home, and the quality agents are the ones that remain, and all the sort of part-timers who just park their license somewhere, kind of
Exactly it.
float away. And you get good quality business and good good service for the whole industry and for the clients.
It's exactly it. Realtors, mortgage brokers, actually, this is the moment where your business and your professionalism in the shifting market will actually, you'll take market share.
Yeah, because and unfortunately in my industry, and I'm sure like yours too, it sort of dilutes what we do. It makes you look bad when you have all these part-timers essentially in the market, and they're sometimes providing very poor advice, advice that's super suspect, and it makes everyone else look pretty bad. And then this type of market where things are harder, having a professional you can rely on who's been around a little longer and can give you good advice is the difference. And I think that's what is able to drive things.
That's why I drive so many people your way, Hugo.
Yeah, I appreciate that, man. But yeah, man, this is
great.
Just my thoughts. If I had to leave a very short soundbite, I would say, I think there'll be a little bit of a roller coaster, but I do personally still think that variable is the best way to go. And what a lot of people don't realize is that the banks make a lot more money on fixed rates because they're counting on you breaking your mortgage every 3.5 years. That's the stat. Every 3.5 years, the average Canadian breaks their mortgage. So the banks make a lot of money. So we've almost been brainwashed, I don't have a better word, to go fixed as Canadians, because that's what the media tells us. That's what the banks are telling you. You should go fixed. And the concept of variable being extremely risky, that hasn't really been the case over the 30 plus years of data when you compare fixed and variable. There are moments where, like, within a 5-year snapshot, you probably got a great fixed rate. Like, I spoke to a client with a 2.25 5-year fixed just today, actually. There's little moments like that, but on average, you're better going variable. So if you're willing to be a part of this little bit of a roller coaster ride, and hopefully it's a very short roller coaster ride, I think you'll see a lot more value when the market adjusts. So that would be my only soundbite for most people, not for everyone. That's why having a conversation.
Exactly. Yeah. It's the individual's, risk level. Me personally, I've never had a fixed product on any of.
Yeah. It's and you don't be a knee jerk. Don't be reacting to this information just because you saw the newspaper, where a lot of bank money is going into advertisements telling you should lock in. Do a little research, and see if this is the right thing.
Like yourself.
Yeah, exactly.
That's it. Who can guide people and make them base decisions, not on emotion, but the actual the numbers. So yeah. Good stuff, Hugo.
Well, thanks for having me.
It's been a pleasure talking with. It's Hugo Dos Reis, founding partner with the Vine Group. And I'm Donal Ward McCarthy with 311 Realty. I really appreciate your time, Hugo. Enjoy Portugal.
Yes, I'll be enjoying some amazing seafood. I haven't had the opportunity to travel anywhere there, so I'm looking forward to seafood and just taking that all in. So I appreciate it. Thank you, man.
Good stuff, man.
Take care, Donal.
Take care, man. Ciao, ciao.